5 signs you're ready to buy your first home. Buying your first home is a monumental milestone, a transformative step in the realm of real estate and homeownership that symbolizes stability, independence, and the foundation of your financial future. It's more than just a purchase, it's a commitment to building equity, creating memories, and planting roots. In today's dynamic housing market, where economic shifts, interest rates, and personal circumstances shape your path, being ready to buy requires careful preparation. Those who approach homeownership with readiness seize the opportunity to grow wealth and security, while others who rush in unprepared face financial strain or regret. The difference lies in the signs that indicate you're truly prepared to take this leap. In this article, we're exploring 5 signs that you're ready to buy your first home, inspired by insights from real estate experts, books like The Millionaire Real Estate Investor by Gary Keller, Home Buying for Dummies by Eric Tyson and Ray Brown, and studies in Journal of Housing Economics. These signs aren't meant to intimidate, they're evidence-based indicators to help you confirm your preparedness, understand the responsibilities of homeownership, and take confident steps toward your dream home. By the end, you'll know if you're ready, how to proceed, and what actions can turn your vision into reality. Stay with us until the end, because you might be closer to homeownership than you think, and these signs could guide you to a life-changing decision. Let's dive into the signs that you're ready to buy your first home and how to make it happen. Sign 1. You have a stable income and job security. The first sign that you're ready to buy your first home is having a stable income and job security, ensuring you can consistently cover mortgage payments, property taxes, and other housing costs without financial strain. Lenders typically require a steady income history, at least 2 years in the same field, and assess your debt-to-income (DTI) ratio, ideally below 36%, to approve a mortgage. A 2019 study in Journal of Housing Economics found that homebuyers with stable employment are 25% less likely to default on mortgages, as predictable income supports long-term payments. In Home Buying for Dummies, Eric Tyson and Ray Brown stress that a secure job is the bedrock of homeownership, providing the confidence to commit to a mortgage. Consider 2 aspiring homeowners, Mia and Noah, both 30 years old. Mia has worked as a nurse for 5 years, earning $70,000 annually with a consistent schedule. Her stable income secures a $300,000 mortgage with ease. Noah, a freelance graphic designer with fluctuating earnings, struggles to prove income stability, delaying his loan approval. Mia's job security paves her path to homeownership, while Noah's instability creates hurdles. Your steady income and secure job signal readiness to buy a home. Stable income doesn't just satisfy lenders, it ensures you can handle monthly payments, e.g., $1,500 to $2,500 for a $300,000 home at 6.5% interest in 2025, per Zillow, without sacrificing essentials. Without it, you risk foreclosure or financial stress. The good news is that you can assess your stability. Review your employment history and calculate your DTI, monthly debt payments divided by gross income. If employed steadily for 2 years and DTI is under 36%, you're on solid ground. Try this. Gather pay stubs for the past 6 months and calculate your DTI this week. If stable and below 36%, contact a lender for pre-approval. Reflect on your job. Is your income steady and secure, or erratic? Stable income and job security are powerful signs you're ready to buy, but you can confirm your foundation now. Sign 2. Your credit score is strong and improving. The second sign that you're ready to buy your first home is having a strong and improving credit score, ideally 620 or higher, per FICO, 300 to 850 range, to qualify for a mortgage with favorable terms and lower interest rates. A strong score reflects responsible credit use, timely payments, low credit utilization, under 30%, and minimal new debt, while an improving score shows progress from past issues. A 2020 Journal of Housing Research study found that buyers with scores above 700 secure interest rates 1 to 2% lower than those below 620, saving $50,000 over a 30-year $300,000 loan. In The Millionaire Real Estate Investor, Gary Keller notes that a solid credit score opens doors to affordable financing, critical for first-time buyers. Imagine 2 young professionals, Emma and Jake, both 32 years old. Emma's credit score is 720, improved from 650 by paying off credit card debt. She secures a 6% mortgage rate, paying $1,800 monthly on a $300,000 loan. Jake's score is 580 due to late payments. He faces an 8% rate, costing $2,200 monthly for the same loan. Emma's strong score saves her thousands, while Jake's weak score inflates costs. Your robust and rising credit score signals readiness to buy. A strong credit score doesn't just lower rates, it boosts lender confidence in loan options, like FHA loans requiring only 3.5% down for scores above 580. A weak score limits choices and increases costs. The good news is that you can check and improve your score. Pull your credit report for free at annualcreditreport.com, dispute errors, and pay down balances to boost your score. Try this. Check your credit score via Credit Karma this week. If 620 or higher, get mortgage pre-approval. If below, reduce credit card balances by 10% this month. Reflect on your credit. Is your score strong and improving, or lagging? A solid credit score is a clear marker you're ready to buy, but you can strengthen it now. If you're finding this article valuable, please comment number 2 below to let me know you're here. Your engagement fuels more content to empower your homeownership journey. Let's keep going. Sign 3. You've saved enough for a down payment and closing costs. The third sign that you're ready to buy your first home is having saved enough for a down payment and closing costs. Typically 3 to 20% of the home's price for the down payment, e.g., $9,000 to $60,000 for a $300,000 home, and 2 to 5% for closing costs, $6,000 to $15,000. These upfront costs are critical to secure a mortgage and finalize the purchase, covering fees like appraisals, title insurance, and lender charges. A 2021 Journal of Real Estate Finance and Economics study found that buyers with adequate savings for these costs are 30% less likely to face purchase delays or cancellations. In Home Buying for Dummies, Tyson and Brown emphasize that cash reserves are your ticket to the closing table, ensuring a smooth transaction. Picture two couples, Ava and Liam, both 35 years old, eyeing $350,000 homes. Ava has saved $35,000, 10% down, plus $10,000 for closing costs, comfortably covering a conventional loan and fees. Liam has only $5,000, insufficient for even an FHA loan's 3.5% down, $12,250, forcing him to delay buying. Ava's savings enable her purchase, while Liam's shortfall stalls him. Your sufficient savings for down payment and closing costs signal readiness to buy. Adequate savings don't just facilitate the purchase, they prevent reliance on risky loans or draining emergency funds, preserving financial stability. Insufficient funds risk deal collapse or debt. The good news is that you can assess and boost your savings. Calculate 10% of your target home price plus 4% for closing costs. If short, automate $500 monthly savings to a high-yield account, 4% APY. Try this. Estimate down payment and closing costs for a $300,000 home, $30,000 plus $12,000. If saved, contact a lender. If not, save $200 extra this month. Reflect on your savings. Do you have enough for upfront costs, or are you short? Sufficient savings are a strong sign you're ready to buy, but you can build your reserves now. Sign 4. You're prepared for ongoing maintenance and unexpected repairs. The fourth sign that you're ready to buy your first home is being prepared for ongoing maintenance and unexpected repairs, budgeting for costs like routine upkeep, e.g., HVAC servicing, lawn care, and sudden fixes, e.g., roof leaks, plumbing issues, which average 1 to 2% of a home's value annually, $3,000 to $6,000 for a $300,000 home, per Home Advisor. Unlike renting, homeowners bear these costs, and unpreparedness can strain finances. A 2020 Journal of Housing Economics study found that 40% of first-time buyers underestimate maintenance costs, leading to financial stress. In The Millionaire Real Estate Investor, Gary Keller advises that homeownership demands a maintenance mindset, ready for both predictable and surprise expenses. Consider two first-time buyers, Chloe and Max, both 33 years old, owning $300,000 homes. Chloe budgets $400 monthly for maintenance, covering a $2,000 furnace repair without debt. Max, unprepared, scrambles to borrow $2,000 for a similar repair, disrupting his budget. Chloe's preparedness keeps her stable, while Max's oversight creates stress. Your readiness for maintenance and repairs signals you're ready to buy. Being prepared for maintenance doesn't just protect your finances, it preserves your home's value and livability, preventing small issues from becoming costly disasters. Ignoring these costs risks debt or deferred repairs. The good news is that you can plan ahead. Set aside 1% of your target home's value annually in a dedicated savings account, and research common repair costs, e.g., $5,000 for a roof fix. Try this. Budget $200 monthly for a $300,000 home's maintenance starting this month. Research one repair cost, e.g., HVAC, to confirm readiness. Reflect on your mindset. Are you prepared for home upkeep or overlooking it? Maintenance readiness is a key sign you're ready to buy, but you can budget for it now. If you're still with us and finding this insightful, please comment number 4 below to let me know you're here. Your support inspires more content to boost your homeownership success. Let's move to the final sign. Sign 5. You plan to stay in the area for at least 5 to 7 years. The fifth and final sign that you're ready to buy your first home is planning to stay in the area for at least 5 to 7 years, ensuring you can build equity and offset upfront costs like closing fees and real estate commissions, 5 to 6% of sale price, before selling. Short-term stays often lead to losses, as home appreciation, averaging 3 to 5% annually, per Case-Shiller Index, takes time to outpace costs. A 2019 Journal of Real Estate Research study found that homeowners staying less than 5 years lose an average of 10% on their investment, while those staying 5 to 7 years gain 15%. In Home Buying for Dummies, Tyson and Brown note that long-term commitment makes buying worthwhile, as equity grows over time. Picture two families, Sophie and Ethan, both 37 years old, buying $350,000 homes. Sophie plans to stay 10 years. Her home appreciates to $455,000, netting $80,000 after costs. Ethan moves after 3 years. His home's $380,000 sale price yields a $10,000 loss after commissions. Sophie's long-term plan builds wealth, while Ethan's short stay costs him. Your intention to stay 5 to 7 years signals readiness to buy. A long-term stay doesn't just ensure financial gain, it allows you to enjoy your home, customize it, and establish community roots. Short-term plans risk losses or frequent moves. The good news is that you can evaluate your plans. Assess job, family, or lifestyle factors tying you to the area for 5 to 7 years. If stable, proceed with buying. Try this. Write down reasons you'll stay in your area for 5 years, e.g., job, schools. If confident, meet a realtor this month. Reflect on your plans. Do you intend to stay 5 to 7 years, or move sooner? A long-term commitment is the ultimate sign you're ready to buy, but you can confirm your stability now. Final thoughts. Now that you've explored these 5 signs, take a moment to reflect on your homeownership readiness. Do you have a stable income, strong credit, ample savings, maintenance preparedness, and a 5 to 7 year commitment, or are you still building toward this goal? The good news is that readiness can be cultivated, and every step you take, whether it's checking your credit or saving for a down payment, is proof you're moving toward your dream home. These signs, stable income, strong credit, sufficient savings, maintenance readiness, and long-term plans, highlight when you're prepared to buy, but they also guide you to a smart, confident purchase. Don't let uncertainty delay your homeownership dreams. Your journey to a home starts now. Pick one sign, like getting pre-approved or budgeting for maintenance, and commit to it this month. Read books like The Millionaire Real Estate Investor or Home Buying for Dummies for deeper insights, and connect with a realtor or lender for tailored advice. Buying your first home can build wealth, create stability, and fulfill your vision of homeownership. Take action today, and let these signs lead you to a future where your home thrives, your equity grows, and your dreams become unstoppable. If you're finding this inspiring, please comment number 21 below to let me know you're here.